Now, more hope that inflation could be easing a bit. A key measure of price changes at the wholesale level increased at the slowest pace since early 2021. The Producer Price Index increased 2.3% from year over year, and it rose just 0.2% from last month. The Producer Price Index is a measure of the change in prices that producers pay. And here to give me an on-the-ground perspective is the head of manufacturing company HM Manufacturing, Nicole Walter. So we got the Producer Price Index today, and I thought to myself, who better to speak to than a producer herself, right? So I remember the last time, or a previous time that we spoke, you mentioned inflation was one of the top concerns for you. So I'm wondering now, is inflation pressures easing for you?
They are, but, we're also concerned on the manufacturing side of a constriction. As inflation is easing, it's good to see for the consumer side of things. But on a manufacturing side, we are worried. I've talked to a lot of colleagues and peers that we are seeing a softening when it comes to orders and quotes and new business. And so that's what we're looking at. We're also looking at what Germany is up to as well. I know that they're considered a winter recession right now, that they were dropped so many points from what they were expecting. And so when you're a global manufacturing company and you deal a lot with Europe, those are the things that we're really kind of looking at to see what is happening for the future, what is happening for next quarter. And so even though inflation is easing, there is still more on the worrisome side of what's happening for new orders and new business.
So basically what's happening is that costs for you have come down a bit, let's say, but demand has also come down for you.
Correct. And, we're seeing that in a lot of interesting ways. So material that used to be super sky high has gone down. Plating, when there used to be big surcharges from last year and the year prior, that has ceased and gone away. But you are seeing a lot of uptick, especially for my side, on the food processing, beverage, and packaging, OEMs and manufacturing. We are seeing that they have done a lot of overbuying, and so a lot has been stocked on their shelves. So we don't see a lot of new business popping up. And we also are seeing where a lot of my people, essentially, like my workers, my team members, they're also seeing a slowdown and they're kind of getting concerned. But when you look at companies as a whole, they're also asking for some rebates and seeing how they can start doing some cost cutting from last year to this year.
So what do you think is a big reason for why demand is coming down?
I think, again, there was that over purchasing because supply chain was just such a mess last year that a lot of the OEMs decided to gain more on the front side. And so I think as things are starting to materialize in the sense that things have gotten better, you don't see as much kind of going out the door. And when I mean throughput going out the door, so a lot of my bigger customers, you see that they're kind of pushing out what they were originally looking at for an EAU kind of down the line. So when we were expecting 500 pieces maybe in August, now it's been pushed to October and November. And I just think it's because they just did overbuying. And that's good, I guess, for the consumer side of things, right? When you see a lot of sales, I know food has gone down a lot. Gasoline prices have kind of gone up a bit just because it's travel season. But, you do start to see on the retail side that there is just too much in inventory. And, us at HM, we did a really good job with keeping inventory low. But at the same time, it is kind of worrisome when you don't see things as they used to be for last year. And that kind of hurts the forecasting for us when it comes to growth patterns, hiring patterns, stuff like that. Everything right now is a little bit too volatile. And so we're all kind of just trying to take a seat back and try to watch what the markets do. We're trying to watch what happens with this debt ceiling issue, as well as the Fed rates that are going to come. So a lot of our smaller manufacturing, small business, we're kind of just waiting in limbo right now to see what happens, and then kind of go to our larger customers to see what the end game is for them.
So you mentioned a couple of points here, and I want to touch on them, but just a quick follow-up on costs coming down for you. What exactly have come down?
So for us, it's more on the material side, it's the plating side, heat treating, and I do see some softening in the wage market as well, which is really interesting because before it was a mad dash to try to keep your team members, try to hire. Everyone was kind of throwing money at the problem. And you do start to see, especially in manufacturing, where there's a lot of more stability in terms of people not leaving companies and going to another competitor for a couple extra bucks or things of that nature. But your burden rates definitely are not going down. I mean, my machine rates that I did in terms of new purchases, that's a fixed rate. So your burdens are still kind of creeping up, but in terms of everything else, like your materials, your raw materials, your purchasing, like subcategories, that has gone down a lot.
And you mentioned the Fed's interest rate hikes. How is that impacting your business?
Well, we're trying to figure out what we're going to do for next year. You know, we are always on the cutting edge of purchasing new equipment. And so every year we reevaluate to see what we're going to do. And if they do decide to raise, which I think they're going to have to, right? Because everyone is talking about whether it's going to be a soft landing, a hard landing of this recession, and no one really knows. So we're just trying to figure out what they're going to do. So if they do raise it, does that mean that we purchase capital equipment maybe later in the year, maybe more into next year, than trying to get the purchase orders for this year and locking in that rate? So it's kind of just like hedging the bet of, do you want to pay it now or do you want to pay it later? And the way that things are with this softening market, I think all of us in manufacturing are pretty much just going to be status quo for a bit. I've seen a lot of kind of ebb and flows where we used to see a lot of quotes and purchase orders kind of trickle in every week. And now you see one week where it's just a lot of quoting and no purchase orders. And the following week, there's a lot of purchase orders, but no quotes. And so it's interesting to kind of get a sense of what we're going to do. And so for now, we're just going to hold back. We're just going to watch the markets as they kind of do their thing. And we're going to see what happens with the Feds and what that ends up doing in terms of bank lending as well, since I know that's tightening.
Right, yeah, let's talk about credit conditions. You know, with banks trying to shore up their balance sheet, how's your business reacting to the current credit conditions?
Well, you know, as a small business, cash is king, right? And so we are doing everything that we can to tighten up our spending and to keep more cash on hand. Because if we do decide to purchase new capital equipment, I do think that the qualifications for loans and bank lending are going to be significantly different than they were last year. You know, for us in small business, we do need that, right? We do need credit lines. We do need better ways to access capital. And when you start to see that tightening, it is a little concerning as to what you want to do for next year and stuff of that nature. But for us, we're keeping where we are. We're just going to make sure that we don't shave off too much and that we're going to stay consistent, because if we do have to dip into a credit line, if things do get quite stale, we have to make sure that our balance sheets are really good for the banks in terms to lend us some cap.
All right, so another follow-up on a previous point. So we got the jobless claims numbers today. Now at the highest level since October 2021. So has it been easier or harder to find workers now compared to before?
I would say it's a little easier. We do have 2 job openings, and I'm seeing on the ready that there is more activity. But the problem for us in manufacturing is it's always the skilled labor. And for us, we've just been kind of going more into the automation side of things, because in manufacturing, we call button pushers. And that's someone that is just standing at a machine and just pushing buttons. And so we're looking for more skilled, waged employees. And so what we're looking for is people that have more NIMS certification, that have more turning capabilities, milling capabilities. And so that is starting to kind of filter through. Before, you were getting people that didn't really have those types of skills, and we were taking them in and upskilling them as well. But we're seeing more skilled labor start to hit the market, which is really great for us in manufacturing since we're hurting for help at this point.
I wonder if generative AI, that's in the news a lot recently. Is that any use to you?
Not right now, not for us in small business and small manufacturing. But I do think that that is going to be prevalent coming in the future. But for now, it's just something that we're looking at. Automation for us in robotics is definitely where we're really spending a lot of time and resources on to gather that technology and put that into our shop floor.
And maybe just a couple more things. We recently had a business optimism survey, and one of the things that it showed was that actually nearly 1 out of 5 businesses reported that supply chain disruptions still have a significant impact. I wonder if that's happening still for you. Are you seeing anything on this front?
No, we've been fortunate. I think all of those problems for us have been left in 2022. So we're able to now get our materials every day. Used to be last year where it would take several days because not only did they not have the materials, they also didn't have the trucking lines that were able to deliver that material as well. But we are seeing raw materials come in on the daily. Like I said before, we're seeing it where prices have dropped on that front. I think everything for us has really stabilized. We are seeing a lot of that subcomponents also be on the ready. We also have inserts that we need that we have to use in order to machine our raw material. That is now readily available. So for us, we're seeing things go back to pre-COVID levels.
All right, I just want to end this on a more pleasant note. What are you optimistic about on the horizon?
You know, there is a lot of movement in aerospace and defense. E-mobility is huge and gaining a lot of traction. And I'm excited for the automation and robotics for manufacturing because that's what's keeping a lot of us very busy right now. A lot of really great R&D work is happening. We are starting to see a lot of filled positions happening in manufacturing. And so I think that's a great thing. I'm excited about that. I'm excited about the new projects that are going on. And so I'll keep it there because the rest is a little scary, but there is still movement. We are still producing, and that's a great sign for U.S. manufacturing.
All right. Thank you, Nicole. Great having you on today.
Yeah, thank you so much.
Now, 80% of the monthly rise in the PPI was due to services. That's things like food wholesaling and healthcare related costs.